Inflation, recession, bull markets, bear markets. You hear these words thrown around all the time on the news, right? And they sound super complicated, but they're not just for economists. These things actually have a huge impact on your wallet, from what you pay for groceries to how secure your job feels. So let's cut through the jargon and break it all down together.
So first up, we're going to talk about the prices you see every single day. Then, we'll kind of zoom out and look at the big picture of the economy's health. After that, we'll take a quick trip into the world of the stock market, and finally, we'll find out who's actually pulling the levers behind the scenes.
Okay, let's dive right in. Section 1, the price of everything. We're starting here because this is where economics gets really personal. It's all about the things that put a squeeze on your wallet.
I mean, we've all had this feeling, right? You're at the grocery store, you get to the checkout, you look at the total, and you just think, whoa, wait a minute, how did it get so high? Well, that feeling actually has a name, and it's a huge deal in economics.
It's called inflation. And here's the kicker. It's not just that prices are going up. It's that the actual value, the buying power of your money is going down. That $100 bill in your wallet today literally buys you less stuff than it did last year. And look, this isn't just some number on a screen. It's the reason your grocery bill is higher. It's why your rent went up. It's what you're feeling at the gas pump. When all these basic things get more expensive, it directly affects what we call the cost of living.
The cost of living is exactly what it sounds like. It's the amount of money you need just to cover the basics. You know, a roof over your head, food on the table. So when inflation goes up, it really puts a strain on people's budgets because the cost of simply, well, living gets higher.
So if inflation is the what, then what's the why? What's the engine under the hood making all these prices tick up and down? Well, it pretty much all comes down to one of the most basic ideas in all of economics.
Supply and demand. It might sound a little technical, but I promise it's simple. Just picture a lemonade stand. Supply is how much lemonade you've got to sell. Demand is how many people walk by feeling thirsty. The price of a cup really just depends on the balance between those two things. I mean, just look at the housing market for a perfect real-world example. You've got tons and tons of people who want to buy a house. That's huge demand. But there aren't that many houses for sale. That's really low supply. So what happens? When you have a lot of buyers chasing just a few homes, the prices naturally go through the roof.
Okay, for Section 2, we're zooming out. We're going to go from our own wallets to the big picture, the economy's ups and downs. Because you got to remember, the economy is always moving in cycles.
You hear the word recession in the news all the time, and it always sounds pretty scary. But all it really means is that the whole economy is shrinking instead of growing, and that slowdown, unfortunately, often leads to things like job losses.
See, the economy pretty much always moves between these two phases, boom and bust. A boom is when things are great. The economy's growing fast, jobs are easy to find, people are spending. A bust is the exact opposite. It's like someone slammed on the brakes and things suddenly go downhill. They're just two sides of the very same coin. Think about the tech industry. For years, it was just in this massive boom. Companies were hiring like crazy, growing at an insane pace. But when that cycle turned, the boom quickly became a bust, and suddenly you saw widespread layoffs and companies struggling to survive.
And one of the key ways we measure the health of the economy is the unemployment rate. Now, here's a really important detail. This number only counts people who don't have a job but are actively looking for one. It doesn't include people like students or retirees or anyone who isn't trying to find a job right now.
All right, let's switch gears and head into the wild world of the stock market. It's got its own language, its own lingo. It's kind of like a financial zoo, full of bulls and bears and these things called bubbles.
So, what's the deal with all these animals? Well, it's pretty easy to remember. A bull market is when investors are feeling optimistic, and stock prices are generally heading up over time. Just think of a bull thrusting its horns up. A bear market is the opposite. People are pessimistic, and prices are trending down. Think of a bear swiping its big claws down.
There's this great saying that just perfectly captures the feeling of a bull market. When stock prices just keep going up and up, it's really easy to feel like you're some kind of investing genius. But of course, the real test is what happens when things start to go the other way. And sometimes, all that optimism gets a little out of hand, and it creates what's called a bubble. This is when the price of something, could be stocks, could be houses, gets inflated way, way beyond what it's actually worth. And, well, we all know what happens to bubbles, don't we?
They burst. The 2008 financial crisis is the textbook example. The whole thing started with a massive housing bubble. When that bubble finally popped, home prices just collapsed. And that was a huge problem because the big banks had bet tons of money on those prices staying high.
so their stocks crashed, which then triggered a huge market crash and ended up wiping out billions of dollars in regular people's retirement savings.
Okay, last section. Who pulls the levers? I mean, with all these booms and busts and bubbles, you have to wonder, is anyone actually trying to steer this ship? And the answer is yes, kinda. There are two main tools that get used to try and manage the whole thing.
The two big ones you need to know are monetary policy and fiscal policy. So monetary policy is all about interest rates, and that's handled by the country's central bank. In the US, that's the Federal Reserve. Fiscal policy, on the other hand, is all about government taxing and spending decisions. That's handled by, well, the government.
Now, this stuff might sound really high level, but believe me, you feel the effects in your daily life. When the Federal Reserve raises interest rates, that's monetary policy in action. It gets more expensive for you to get a car loan or a mortgage. And when the government decides to pass a tax cut, that's fiscal policy. You might actually see a little bit more money in your paycheck.
So there you have it. Inflation, supply and demand, booms and busts. These aren't just buzzwords for the evening news. They're the invisible forces that shape our world every single day. So the next time you're reading the headlines, keep an eye out. See if you can spot these forces at play, because now you've got the tools to see what's really going on.